Inflation makes most people poorer. You're going to learn how to not just neutralize, but actually profit from inflation 3 ways at the same time with the Inflation Triple Crown. Hi, I'm Keith Weinhold. This is Get Rich Education. The definition of inflation is an expansion or inflating of the overall money supply, the number of dollars effectively that are in circulation. Over time, that definition has somewhat morphed rather to mean the diminished purchasing power of the dollar or the reduced value of the dollar that you often see reflected in, for example, consumer purchase prices, where it costs more dollars to buy that same exact thing than it did 1 year ago. If you take a look at this chart here, over time, you can see the weakening of the dollar such that a dollar is worth just about 1/26th of what it was about 100 years ago. So therefore, the dollar only has 3 to 4% as much purchasing power today as it did a little over 100 years ago. You can also see in the chart during the 1930s, the dollar strengthened for a time during the Great Depression. Therefore, that was a deflationary period. August 15th, 1971, President Richard Nixon effectively took the dollar off the gold standard. That means almost endless dollars could be printed because you didn't need to hold a certain amount of gold for each dollar in circulation. So therefore, that's why during the 70s and 80s, you'll see stepped up higher inflation during those periods of time. In fact, if you take a look at this McDonald's menu from 1974, take a look at some of those prices there. This is just a few years after Richard Nixon basically depegged the dollar from gold completely. Yeah, Big Mac costs 65 cents. Today, a Big Mac costs $4. So that is really the effect of inflation. Postage stamps this year are being increased in price from 55 cents to 58 cents, just your regular old everyday first-class stamp. Inflation doesn't only affect consumers for consumer purchases, of course, it also affects investment gains for investors. And so many people overlook this, and traditional stock and mutual fund advisors often don't want to talk about the effect of inflation because it dilutes the return. In fact, if you have a 9% return from stocks, that's really just known as a nominal return. Nominal means in name only, because if you have 4% inflation, well, therefore, the 9% stock return minus 4% inflation means you only have a 5% inflation adjusted return. And you really need to do what I like to call tilt the chart. Traditional financial advisors wouldn't want to talk about tilting the chart. Let's say this is that 9% stock return over time. If it doesn't say inflation adjusted on that chart, which it usually doesn't, you need to tilt the chart clockwise a little ways to adjust for the effects of inflation, that diminished purchasing power of the dollar over time. Tilt the chart if it doesn't say inflation adjusted. Be sure to do that the rest of your life. You need to tilt that chart clockwise. So inflation is typically an economic malady for both consumers and investors. The way you can profit from inflation, and this is the first of 3 crowns of the Inflation Triple Crown that we're going to focus on today, what you need to do is buy real estate with a loan where the rent income exceed all the monthly expenses, including that loan cost, meaning it positively cash flows. If you do that, you can win the Inflation Triple Crown. The Triple Crown is, number 1, price inflation, number 2, debt debasement, and then the third crown in the Triple Crown is cash flow enhancement. So in this first of 3 videos on the Inflation Triple Crown, we're going to talk about price inflation on this piece of real estate that you bought. Let's just say over a period of time, it might be 1 year, 2 years, whatever it is, we have 10% total cumulative inflation. And let's say you have a $1 million, we'll just call it an apartment building. You might also think of this $1 million as the total value of all the real estate in your portfolio. Well, if we have 10% price inflation over time, the value of your real estate then, say it goes from $1 million up to $1.1 million. And you might be wondering if you're any further ahead. because although you have 10% more dollar denominated price of real estate, each one of those individual dollars is worth 10% less. So aren't you right back where you started? The answer is no. Because remember, I told you that you have a loan on this property. So therefore, if you had a 20% down payment on this property, therefore $800,000 worth of debt, your equity of $200K just went up to $300K because you had $100,000 of price inflation. So therefore, though there was 10% inflation over time, the equity that you get to feel in your pocket just increased from $200K up to $300K. Therefore, you have a 50% gain, even though inflation only went up 10%. You're starting to win. You're getting ahead. Why? How did that happen? Because you're leveraged. You got a return effectively from inflation on both your 20% down payment and the 80% borrowed from the bank. Look, if you had more equity and you had less borrowed, say if you only had $700,000 worth of debt and $300K of equity in this property, and the same thing would have happened with the $1 million up to $1.1 million price increase, well, your $300K of equity only would have gone up that same $100K to $400K. Therefore, you only would have had a 33% gain, not a 50% gain, because you weren't borrowing as much from the bank. You want to be that savvy borrower with that fixed interest rate debt tied to a cash flowing asset. It's important to remember that inflation debases your equity and it debases your debt at the same rate. So debasing your equity, that's a bad thing. Debasing your debt is a good thing. And that's why you got ahead in this example. When you borrowed more, you had a higher return than when you had borrowed less. Again, inflation debases equity and debt at the same rate. Hey, you don't have to, but if you would, put a YouTube like on this video. That tells YouTube that it's a good video, and it helps ensure that you'll see more material like this in your feed. So you don't have to, but I'd really appreciate the YouTube like. Sometimes inflation's effects are hiding, and they aren't so apparent as they are with the Big Mac or the ever-increasing price of a United States postage stamp. Sometimes they're hiding. One way is with what's called shrinkflation. That's where a manufacturer reduces the package size of something over time, yet they don't reduce the price. Shrinkflation. So the etymology of that word is it's a portmanteau of shrink and inflation. Ragu spaghetti sauce recently gave us some shrinkflation when they shrunk a jar of spaghetti sauce from 28 ounces down to 24 ounces. And you know, when manufacturers do this, they never seem to announce that it's a new, smaller size for the same price. But if they raise the amount of spaghetti sauce the following year from 24 ounces up to 28 ounces, you could be assured that would be splashed all over the jar. So inflation often hides. Another way is in a loss of food quality. Say a cookie manufacturer keeps turning out the same amount of cookies, and the cookies are also the same price. However, that manufacturer starts to get rid of some of the good coconut oil in it, and they remove the coconut oil and say they replace it with something lower quality, like a hydrogenated vegetable oil. So a reduction in quality is another place that inflation hides. We're talking about consumer price inflation here. There is also service inflation. For example, say a postage stamp costs the same amount from one year to the very next year, and it still delivers a letter of the same weight. However, with this loss in service, say it takes 3 days to deliver a letter this year, where it only took 2 days last year. Well, you experienced a reduction in service for the same price. That's service inflation. Another example of service inflation is when you go to the grocery store and you now more than likely scan your own groceries, or at least you're doing it more often than you were 10 years ago. The producer, the retailer, has outsourced that service to you. So now you can no longer scroll your phone or peruse through a magazine. You need to be the one checking out your own groceries. It's another example of service inflation. You know, I recently experienced a kind of hidden inflation that one doesn't often think about at my favorite Mexican restaurant. It's called Qdoba. I bought the steak burrito. It cost $10.50. I've seen that price go up over time. But in any case, the new price increase I saw is one that you don't see up on the menu board there. When I went to pay for my Qdoba burrito recently, I was asked a question at the little payment terminal that I was never asked before. Would you like to leave a tip? 0%, 5%, 10%, or 15%? So now there's that expectation and that tip guilt to leave a tip. So it's another place that inflation comes into our life where you're paying more to get the same thing that you got previously. There are more examples that inflation is increasing throughout society. When you look at wage inflation, we now see a minimum wage of $15 at a lot of companies you've heard of. Amazon, Costco, Target now has a minimum wage of $15. Best Buy, Walt Disney World, Wayfair, Bank of America has a minimum wage of $20 now. So we're seeing higher and higher minimum wages, and that could increase the prices of everything in society because therefore those businesses need to pass on higher prices to you, the consumer. More and more evidence of inflation. Look, when the gross domestic product year over year only rises 3%, but the supply of dollars issued rises 10 or 20%, well, by definition, you've now got more dollars chasing fewer and fewer goods because gross domestic product is basically the total output of all the goods and services that a society produces. So you have more dollars chasing the same amount of things or substantially more dollars only chasing a few more items. And look what happened in the last recession. People were paid to stay home. So when people stay home and they're getting paid more money into the economy, yet they're not at work producing any of those goods, now you've got more dollars chasing fewer goods. So we're really setting up a scenario for more inflation. It takes months to get things from lumber to ski boots because people are staying at home and they're not producing anything. That increase in demand bids up prices for items, more inflation. So you've got to profit from it. So you don't want to be a saver. You want to be a borrower to benefit from inflation. We'll talk more about the borrowing part in the next video, which will be the second crown of the 3 Inflation Triple Crown videos. Savers get their savings debased by inflation. A saver gets about 0% right now. So $1 million saver at a 3% inflation rate really only has $970K of inflation-adjusted dollars after 1 year and $940K after year 2. So don't be a saver. Do the opposite and be a borrower because inflation transfers wealth from lenders to borrowers. So you want to get a loan on this property. Inflation also transfers wealth from older people to younger people. And you might be wondering, why would inflation transfer wealth from older people to younger people? That is because older people have more assets and younger people have more debt. So then what's the wealth formula for you? As you age from younger to older, keep your smart debt. Debt is smart when the payments are outsourced to others, your tenants. You're creating leverage with it, with this price inflation that we're talking about here with real estate. So I'm an inflation cheerleader in a sense, I'm like, go, 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 because it's good for me because I have a lot of these loans with long-term fixed interest rate debt tied to cash flowing property. Inflation, debt, and taxes are 3 things that make most people poorer. Here at Get Rich Education, we talk about how you can use those to create real wealth for yourself when you're actually young enough to enjoy it. So the bottom line is to benefit from this first crown in the inflation triple crown, which is price inflation, have an income property with a mortgage. Hey, I learned that in order to get the second and third videos in this series that are upcoming, you need to subscribe and then hit that notification bell as well. If you subscribe only, I'm very appreciative of that, but you won't be notified that the second and third videos in this 3-part Inflation Triple Crown series are delivered to you. In the next video, we're going to talk about the second crown of the Inflation Triple Crown. We're also going to talk about how to measure inflation. My name's Keith Weinhold. Thanks for being here, but you weren't here for me. You were here for you. I'll see you in the next video.